When people say the economy is booming or struggling, what do they really mean? Is it just about rising prices, the stock market, or unemployment numbers? In reality, the health of an economy is measured through a set of powerful indicators that reveal whether the nation is truly growing, stable, or headed for trouble. Let's break down how to read the signals and what they tell us about our future. My name is Ivan Savchenko. Welcome to Magnet Trade. Without further ado, let's hop into the video. Before delving into the details, it's essential to understand why these indicators are important. They are not just abstract numbers on a chart. They influence government policies, business decisions, and even the everyday lives of ordinary people. By tracking them, we can see whether growth is sustainable, if risks are building up, and how an economy compares on the global stage. So, let's begin with the foundation of any economy, its output. At the heart of this lies gross domestic product, or GDP.
GDP, or nominal GDP as in our example, can be expressed as an equation that sums up all of its components. The first one being a nation's level of consumption, which represents the sum of goods and services purchased by citizens. This is retail items or rent, and it grows as more is consumed. It's the largest component of GDP. Investment, on the other hand, refers to any capital expenditures in new assets that will provide future benefits. To invest in business activity, companies spend money on purchasing equipment, inventory, and building new establishments rather than services. The difference between consumption and investment is the period over which a purchaser gets benefits. Also, the main factor is government spending on goods and services, something like education, military, transportation, etc. etc. This spending is financed by taxes, companies, or borrowed money. Last but not least is the exports-imports part of the equation, the difference between goods sold compared to the amount of goods bought by domestic consumers from abroad. Therefore, we get an equation: consumption plus investment plus government spending on goods and services plus export minus imports in brackets equals GDP. What we have just discussed is nominal GDP. It measures the value of output at current prices without adjusting for inflation, while real GDP adjusts this total for inflation, showing the actual growth in economic output rather than just price increases. It's considered the most accurate measure of economic health, as it reflects changes in the quantity of goods and services produced over time. This makes real GDP more reliable than nominal GDP for comparing different periods or economies.
But measuring growth alone isn't enough. After all, what good is growth if it comes with soaring prices? That's where inflation enters the picture.
Inflation is the rise in prices over some period, usually a year. Inflation is measured in four main ways. Headline inflation is a measure of price changes that looks at a broad array of goods and services in the economy. Core inflation is a measure of underlying inflation. It removes food and energy prices, which tend to be volatile from the headline number. CPI, Consumer Price Index, tracks the average change over time in the price paid by consumers for a basket of goods and services, which represents the average household's purchases. PPI, Producer Price Index, measures the average change over time in the prices received by domestic producers for their goods and services. Rule of thumb: good inflation report equals inflation is near target, stable, and aligned with expectations. For the US and Eurozone, it's approximately 2%. Bad inflation report equals inflation is too high or too low. Deflation, a period of falling prices. It feels like falling prices should be good for consumers, right? But economists usually view deflation as a hazardous sign due to several reasons. First, reduced demand. Why buy a car today if you think it will be cheaper next month? Lower demand means businesses earn less, cut wages and jobs, and the economy slows down. Second, debt burden. If you have to repay a loan of 2,000, but your salary falls from 1,000 to 800 as prices drop, it feels as if the loan became heavier. Finally, central banks lose tools to control the economy. For example, in recessions, they cut interest rates. But if interest rates are zero and prices are falling 2%, the real rate is 2%.
Now, prices matter, but so do people's jobs. After all, an economy is as strong as its workers, which brings us to the labor market.
Labor market shows one of the most straightforward indicators. Unemployment rate indicates whether people willing to work can find jobs. Labor force participation rate shows how many people are actively working or seeking work, reflecting economic inclusivity. However, such things as part-time or low-wage jobs in place of full employment can mask underlying weakness. But similar to inflation, a zero unemployment rate isn't healthy. If unemployment actually reached zero, it could create labor shortages and push wages up. And higher wages would force companies to set higher prices for their goods and services, therefore leading to inflation pressure. In the US, a healthy unemployment rate is around 5%. In the Eurozone, it's closer to 6.
Jobs and wages influence something just as important: confidence. How businesses and consumers feel about the future often decides whether they spend, invest, or hold back.
Market confidence indicators. There are two widely watched surveys that track confidence in the economy: Purchasing Manager Index, or PMI, based on monthly surveys of supply chain managers across industries. It reflects business conditions in areas like production, new orders, and unemployment. The index ranges from 0 to 100. A value over 50 means expansion, while under 50 means contraction. Consumer Confidence Index, CCI, measures how optimistic or pessimistic consumers feel about the future economy and their personal finances. This sentiment influences their spending and saving habits. A value over 100 indicates optimism, while under 100 shows pessimism.
But confidence isn't enough if the money side of the economy isn't balanced.
Public and private finances, government and private debt. Government debt to GDP ratio measures a nation's total outstanding government debt compared to the size of its economy, GDP. It indicates fiscal health and economic sustainability. Ratios vary widely. In the US, debt is over 100% of GDP. Some European countries are even higher, while countries like Switzerland and Estonia remain below 20%. Higher debt levels are manageable if borrowing costs are low and growth is strong, but riskier if interest rates rise or growth slows. Government budget balance, the difference between total revenue and spending in a year. Surplus equals revenue higher than spending. Deficit equals spending higher than revenue. Balance, revenue equals spending. This balance is a key signal of a government's ability to manage its finances and fund future obligations. Household debt, money owed by individuals, often through mortgages, auto loans, and credit cards. Corporate debt, money owed by businesses, often financed through corporate bonds or bank loans, used for operations and investment. Impact, debt can stimulate spending and growth in the short run, but if it becomes too high, it can create financial risks, defaults, reduced future spending, and deeper recessions when stocks hit.
But no economy is an island. Debt and spending connect directly to trade and international flows, which brings us to external and internal balance.
External and internal balance. External balance refers to the equilibrium of a country's international economic transactions, primarily reflected in its balance of payments. It signifies a current account and capital account position that is sustainable in the long run without requiring trade restrictions and maintaining an adequate and stable level of international reserves. Achieving external balance ensures a country's international competitiveness and overall economic stability. Key components. Current account measures the flow of goods, services, and primary incomes, like wages and investment income, between a country and the rest of the world. Capital account records financial transactions such as foreign direct investment, portfolio investment, and borrowing lending. Internal balance involves achieving full employment and price stability within the domestic economy. Coordination. Both internal and external balances are necessary for overall economic stability, requiring coordinated use of economic policies. For example, a country with an over-appreciated real exchange rate might face a current account deficit and external imbalance, and will need to adjust to restore internal balance as well.
And all of these flows, both domestic and international, rely on one crucial pillar, the financial sector. If banks and markets are unstable, the whole system suffers.
Financial sector health. Banking stability refers to the ability of banks and the overall financial systems to withstand economic stress, remain resilient, and continue providing essential services without disruptions. Key indicators include high capital and liquidity ratios, strong profitability, and the low risk of insolvency, often measured by metrics like the Z-score. Factors influencing stability include sound management, robust regulations, strong risk management practices, and the ability to adapt to evolving challenges such as cyber attacks and geopolitical uncertainty. Interest rates and credit availability are inversely related. When interest rates rise, credit becomes less available and more expensive, while lower interest rates make credit more accessible and cheaper. These rates are influenced by supply and demand, with high demand or low supply for credit increasing rates, and vice versa. Central banks, like the US Federal Reserve, manipulate interest rates through monetary policy to control the economy. Also, a stock and bond markets rally can indicate confidence, though bubbles must be considered.
Stability is key, but progress also depends on how efficiently we can grow.
Productivity and innovation. Just as in any field, economists track productivity. A key metric is total factor productivity, TFP, which measures how efficiently an economy uses all its inputs, like labor and capital. In simple terms, productivity means producing more output while using fewer resources. Investment in research and development, R&D. It's costly in the short run and uncertain, but it brings long-term benefits. R&D drives innovation, improves productivity, strengthens competitiveness, and often creates spillover effects that benefit the whole economy. But innovation can't happen in a vacuum. It needs strong foundation, like infrastructure, education, and healthcare, to truly thrive. The quality of infrastructure, like roads, energy systems, digital networks, and transport, helps determine a country's economic capacity and resilience. Strong infrastructure supports trade, lowers business costs, improves productivity, and makes the economy more stable in times of stress. Access to education and healthcare, crucial for long-term growth and productivity. Education equips people with skills needed for higher value jobs, driving innovation and competitiveness. Healthcare ensures workers are healthy, more productive, and less likely to miss work.
And even with strong foundation, not everyone benefits equally. That's why we also need to look at inequality, poverty, and how fairly opportunities are shared.
Social and distributional factors. Gini coefficient, a standard measure of income inequality, ranging from 0 perfect equality to 1 or 100% perfect inequality. Lower values mean more equal distribution of income. In Europe, the Gini is around 29%, reflecting relatively lower inequality. In the US, it's about 42%, showing higher inequality. Why it matters? Where high inequality can reduce social mobility, weaken consumer demand, and lead to political and social tensions. Poverty rate, the share of the population with incomes below the poverty line. A higher poverty rate limits people's ability to consume, undermines economic stability, and increases dependence on government support. Persistent poverty also lowers human capital, like skills, education, health, and keeps growth potential below what it could be.
Finally, behind all of this are the rules of the game: institutions, governance, and sustainability. They shape whether the economies can grow steadily or fall apart.
Structural and institutional strengths, rule of law and governance. Corruption, weak institutions, or unstable politics undermine economic health. Ease of doing business and regulatory environment encourage or deter investment. Environmental sustainability. Unsustainable resource use creates long-term risks.
All of these indicators may seem separate, but in reality, they are deeply connected. Prices affect wages, wages shape demand, demand drives growth, and growth determines whether governments and businesses can keep their finances stable. Together, they form a web that tells us whether an economy is resilient or at risk. So, when we talk about the economy, no single number can tell the whole truth. Growth, inflation, jobs, confidence, debt, trade, productivity, inequality, and institutions, they are all pieces of the same puzzle. Looking at just one is like watching a single frame of a movie. You might catch a moment, but you'll miss the story. The real picture only comes alive when you see it all together. Thanks for watching. If you enjoyed the video, don't forget to like, subscribe, and stay tuned for more insights into the world of economics.